Recessions can have significant and long-lasting effects on the housing market in the UK. Here are some of the key long-term effects. Decreased property prices. During a recession, demand for housing tends to decrease as consumer confidence wanes and people become more cautious about making large financial commitments. This decreased demand often leads to a drop in property prices. In the long term, these price declines can persist beyond the recession as the market adjusts to new economic conditions. Impact on mortgage availability. Recessions can also affect mortgage lending and availability. Banks and other lenders may become more risk-averse during economic downturns, leading to stricter lending criteria and reduced access to credit for homebuyers. This can dampen demand for housing and contribute to slower market activity even after the recession has ended. Housing market stagnation. Economic uncertainty during a recession can cause potential buyers to postpone purchasing decisions, leading to reduced transaction volumes and increased time on the market for properties. Even after the recession ends, the housing market may take time to recover as confidence gradually returns and buyers regain the ability to secure financing. Regional variation. The impact of a recession on the housing market can vary significantly depending on regional factors such as local economic conditions, employment levels, and housing supply dynamics. Areas with strong local economies and high demand for housing may experience less pronounced declines in property prices compared to areas heavily reliant on industries vulnerable to economic downturns. Housing affordability. While falling property prices during a recession may benefit prospective buyers in the short term, the broader economic impacts, such as job losses and wage stagnation, can affect affordability in the long term. High levels of unemployment and economic uncertainty may make it difficult for individuals and families to save for a deposit or meet mortgage repayments, particularly for first-time buyers. Government intervention. Government policies and interventions, such as stimulus measures, mortgage relief programs, and housing market interventions, can influence the long-term trajectory of the housing market following a recession. For example, initiatives aimed at supporting homebuyers or stimulating housing construction can help bolster demand and stabilize prices. Overall, the long-term effects of a recession on the housing market in the UK can be complex and multifaceted, influenced by a range of economic, social, and policy factors. While recessions typically lead to short-term declines in property prices and market activity, the extent and duration of these effects can vary depending on the severity of the downturn and the effectiveness of government responses and interventions.